Hello, welcome. My name is Karen. We're going to be going through a series of workshops that talk about just understanding how money works and just some money management in general. As you know, a lot of people have gone through some difficult times. Stress is over the top sometimes, especially in the area of finances. So I pray that as you listen to this information, you will be able to take away something, and may God give you the wisdom and understanding to make some differences in your life. So stay tuned as the workshop starts. Thank you so much. Hello, my name is Karen Garenser, and if you've been following along on our How Money Works workshops, you would have seen me talk about Insurance 101. So this is just also to do with insurance, but specifically mortgage insurance, and also the way we need to think differently, maybe around when a situation occurs, how do we deal with that in the best effective manner? So you can see from my picture on the screen, we've got the banks who are more in favor versus the family, and there's a reason for that. So I'm going to go through it, and hopefully you come to your own conclusion. So let's start off with a proverb. Proverb 1:1-3. The Proverbs of Solomon, son of King David, king of Israel, for gaining wisdom and instruction, for understanding words of insight, for receiving instruction in a prudent behavior, doing what is right, just, and fair. So with respect to that, I am of the belief that we need to be able to educate ourselves to understand how money works, and then take some discernment from the Lord in terms of some of the decisions we make before we make them. So let's just continue. And obviously, we have some issues in our country here in Canada, but I don't know where you are in the world. Stats might be similar. I know they're very similar in North America, but we've got 95% of people retiring broke and only 5% financially secure. And there's definitely some reasons for that, which is a lack of education. So this just talks about people who are still retiring and still paying a mortgage, paying debt. When you look at our demographics here in North America, 1/3 of our population in both countries, in Canada and the US, are baby boomers, and we're starting to see those baby boomers carry debt and mortgages into retirement. So the youngest baby boomer is 61, retiring, in the next 4 years, and they're carrying a big, heavy mortgage, which they're probably not going to pay off. So a lot of people are starting to face this issue. I'm not sure, like I said, in the countries where you live, when you're listening to this, if it's similar. I know some countries don't even have mortgages, so maybe this wouldn't be relevant for you, but we certainly just want to offer some education around mortgage insurance so that you understand how it works. So there's basically 3 types of mortgage insurance that we have available here. One is like your commercial home insurance, meaning this actually protects your home against fire, theft, or damage. And then also we have CMHC insurance. It's called a different version in the US, but something similar, which basically protects the financial institution if somebody were to default or walk away, or let's say quit paying their mortgage payment. And so, in other words, when somebody puts a down payment on a house to make that purchase, and then the balance is the mortgage, if you put down less than 20% as your down payment, you will be forced to pay CMHC, which is Canada Housing Mortgage Corporation. They are there, in my personal opinion, to protect the bank. So on a $450,000 mortgage at 3.1%, you're dishing out $13,000 to pay for this insurance premium in case you default. And then, of course, the third is a life insurance that the banks market so that if you die, your house gets paid off. Now, when we look at the CMHC insurance, this is just an example of what happened to one guy, right? So he was basically, the house was foreclosed on, so he was losing his property, let's say due to some financial situation. Maybe it was like a COVID, or Maybe, he lost his job and he couldn't find one. He couldn't keep up with the payments. Life happens to a lot of people. So the property was sold off at 205,000, but he was actually originally insured for 238,000. So CMHC pays out the bank's happy, but CMHC went and got a judgment of 33,000 plus interest accumulated. So a total of 51,000 against that previous homeowner who defaulted. So we pay for the insurance, but it doesn't protect us, it protects the bank. So my advice to you is, make sure you put down 20% or greater as a down payment. And I know it's challenging in today's world, depending where you live. If you're in cities where the home values are very expensive, then it makes it challenging. This is why we see a lot more people renting, and we also start to see the cost of rent increase because everything has to do with supply and demand. A lot of our youth now are not in financial positions to be able to own a home because it is so expensive. Okay, so this is just an article written 20 some years ago on the understanding of mortgage insurance. And I could read you this whole thing, but I just want you to see that it's from the Globe and Mail. And they talk about how it's not very clear and people don't understand what happens when they die, when they're insured, where do the dollars go and how does that all work? So I'm going to summarize it in a much quicker way for you. But basically these 5 paragraphs, I'm going to summarize. So here we go. So mortgage insurance versus, let's say, you owning your own insurance. So this is how it works. You pay for high cost of insurance, right? Basically the premiums you pay, everybody's lumped into the same lot. So short, tall, fat, skinny, sick, not sick, everybody's lumped in. There's no guarantee on the cost of insurance. And so therefore, because it's an average of everybody's health, the cost can be a lot higher. So the bank is in control, right? Even though you're making the premium as part of, let's say, your mortgage payment or separate from your mortgage payment, it debits, the bank is the one who's in control. What I mean by that is the bank is the one who gets the payout. So a lot of times when people purchase this, let's say if you're paying $100 and your mortgage balance is going down, you're still paying $100. So I always question, well, who gets the difference? Let's say if you owed that $450 and you've paid, your mortgage balance now is $350. Who gets that other $100,000? I don't really know how that portion of it works at the bank with the decreasing term. So the death benefit gets paid out to the bank. The premium amount, as I mentioned, remains level. Now, here's the kicker, in my opinion. If you take a look at the medical underwriting, most medical underwriting takes place at the time of death. So there's 2 ways. If you go into a bank and they ask you just a few handful of questions about getting insurance in case you die, then that is what I'm talking about here. If somebody from an external insurance company comes and sees you on behalf of the bank and they do all these medical questions and medical tests, that's different. But we're talking about creditor insurance, where they just ask you a handful of questions. You might not understand that handful of questions. If you answer incorrectly, it's going to show up at time of death when they do the medical underwriting to see if you actually qualify for the insurance. The beneficiary is the bank. So my question to you is, who do you want to get the check? Your family or the bank? And my illustration today will show you the power of you being in control. So here, with you owning it yourself, you know what the premiums cost. Those are guaranteed, so you can get a 25-year term if that's what you want. It's based on your current health, so your medical assessment, right? Not somebody else's. It's not averaged out. If you're in good health, your premiums could be cheaper than with somebody who's not in good health. And then, of course, your family's in control. If you're paying the premium, you're going to be able to receive the benefit. So your coverage remains level. What you pay for is what you get. And then, of course, that premium amount, it's going to be static for that period or that term that you own it for. Medical underwriting is done at the time of application. So insurance companies do their due diligence. They make sure they assess your health. They decide to take on that risk, right? So you could pass away in your second month of the premium and they could still be paying your family $500,000 and maybe you've only dished out 2 premiums. So that's the risk they take, because when they lump everybody and they look at their morbidity and mortality rates, they might take 1,000 people and say, okay, so many will pass away of some sort of illness, or some will pass away from accident, some will live a long, long life. There's all these things that determine the amount of the insurance costs per 1,000. And then, of course, your beneficiary is the family. So let's say this young lady has her spouse pass away. She's still got a mortgage and she's thinking, okay, how am I going to pay that mortgage? Am I going to pay the mortgage, or am I going to have, no money? So unfortunately, she's not in a position to decide. She's kind of, emotionally distraught. So let's weigh that out. So Genesis 41:36, New International Version, said, this food should be held in reserve for the country to be used during the 7 years of famine that will come upon Egypt, so that country may not be ruined by famine. And if you remember, Joseph was the one who was in charge of that, storing up all the abundance of grain and, the foods, so that when they had this famine hit for 7 years, people could come and they could trade and barter, and they could make sure that they fed the people of Egypt. So that is like insurance protection, olden day insurance protection, right? So I just want you to think about it. There were provisions back then, and there should be provisions today. So let's say this is a traditional mortgage insurance with the bank. So let's say the death benefit was $400,000 to cover that cost of the mortgage. Let's say that 25-year mortgage, this family's making a $276 payment per month. And it's a decreasing death benefit, but a level payment, right? So the death benefit is going down as you're paying down your mortgage, but you're paying the same amount. And my experience has been, excuse me, it is always cheaper to own it yourself than to do it through the bank, for the reasons I talked about before. So let's say this 35-year-old breadwinner passes away within 1 year of purchasing their home. So now, the spouse that I showed you in the previous page, maybe she's got some kids, maybe she was a stay-at-home mom, like there could be a number of factors. But the mortgage insurance pays the bank and the family is left with no money. So again, should she have her mortgage paid off or no money? So let's just assume, this is the typical situation we're seeing with families. So we have to look at an alternative, right? So let's say with a traditional life insurance for $500,000 of coverage, even though that mortgage was $400,000. So this is the person who passed away owning this personally, right? So the $500,000 is the total payout for death. The breadwinner passes away. So that family can choose to pay out the mortgage, eliminating that $2,176 mortgage payment, and they have $100,000 of cash left over, which is not enough for retirement, but maybe gives them some bereavement time, some time to deal with what just happened. That is better. But now she's thinking, okay, if I totally pay off my mortgage, what am I left for retirement if my job's to raise these kids? Now we have to think about the impact of that, right? Because if there was no coverage, or she totally did it the way we've all been instructed to do, which is pay out the mortgage, she may have to go and get a full-time job. Now they've lost one parent and now this parent is working instead of being able to provide for the family and stay home. So things to think about. That's why it's always better to have more coverage than less, as I had shared in the Insurance 101 How Money Works session. So let's take a look at an option. So let's say we think outside the box. When I talked to you about the 95 and the 5, 5% of our population that are either financially okay or financially bulletproof, you have to ask yourself, do they think differently about money? Do they use their money differently? Do they use different strategies than typical people who are middle market families, hardworking families? But because nobody educated us about money and we don't get to rub shoulders with these wealthy people that understand all this stuff, how do we know we're making the best decision for our family? Not just immediate, but also long term. So here's an example. So 500,000 of coverage, this 25-year mortgage that's outstanding at $2,100 a month in payments. So instead of doing what traditionally most people would do, the breadwinner passes away within 1 year. The family is going to take that 100,000 for themselves, right? And be able to grieve and take time off work without worry. But the family is going to invest, the remaining spouse is going to invest that 400,000 and then draw off that $2,100 mortgage payment every single month to pay that bill. The end result is they'll have the house paid for in that 25 years and money saved. Because stats tell us that a lot of people arrive at retirement unprepared, or they don't have enough money to have a good lifestyle that they work so hard for. It's because we don't think about thinking it differently around money and finance. So I just want to show you some numbers to prove that this actually works. So here we have this 400,000, and let's say it averages a 6% rate of return. And we take that money out for the $2,100 out to make the mortgage payment, right? Now, remember, this person was in their 30s, but I wanted you to just see that if they start, I know here I have age 60, but I'm just illustrating time. This is like a 15-year period, right? So if they, paid off that mortgage, they took that money over time, you can see that easily enough, they would have enough money over the course of their 20-year mortgage or 25-year mortgage to be able to pay that off. At a 6% return, they might be cutting it kind of close, but at a 7% return, you could see that money would last way longer than a 25-year mortgage. So even though I have age 60 to age 100 down at the bottom, it's just to illustrate. So let's just look at that particular mortgage, right? So here we have that $400,000 invested on the right-hand side. Then you can see the next column over to your left is the $2,100 that's coming out every single month, right? And then the column next to that on the left just shows the earnings on top of the withdrawal. So you can see that it's just kind of taking care of itself. So the top is the first 8 years, and then I just ran from age 50 to age 59, right? So let's say this person is planning for retirement. They've now paid their mortgage, is totally paid off by the time, let's say they want to be able to retire, and you can see they still have a balance left over $400,000. So in 24 years at age 59, the house is paid for, and that 2,176 can now actually choose to become retirement income. So let's just say, because that person is 59, let's say they're going to work for another 6 years, okay? And they just let that 400,000 compound. So if they get a 7% rate of return over that 6-year period, and there are lots of funds that have proven to have performed that way, that money in 6 years would be worth $624,000. So let's play that out. Let's say now she's retired, she's 65, she's drawing out $3,500 out of that 624 at a 7% rate of return, and then she's going to live on that money at age 65, and that money will grow. You can see the blue bar going upward, so it never. In other words, you're drawing out less than your investment is making. So you're always in the positive and your investment's going up. So bottom line, $500,000 home, fully paid for. Not that she's happy she lost her husband, but this is retirement. She looks pretty good for 65. And then of course, she's drawing out $42,000 a year in retirement, and she has left over $1 million to her estate. So 2 Corinthians 9:8 says, and God is able to bless you abundantly, so that in all things at all times, having all you need, you will abound with every good work. Now, of course, the Bible has over 2,300 verses to do with money and finance. Obviously, it's talked about more than heaven and hell in the Bible. So we need to be understanding how to preserve our wealth, but not do it in a way where, we don't put God first. God has to be first in every decision we make. He gets the first fruits, but we have to also trust that he will give us the wisdom and understanding when we ask for advice to determine what is the best decision for ourselves. So thank you very much. I appreciate you listening today, and stay tuned for another one.